Day trading can seem like an extremely lucrative business. You probably saw one or two social media influencers running up in their Lamborghini, which is really just rented, selling a course on how to day trade, and thought to yourself, wow, day trading will make me rich. All I need is the right
knowledge.
Unfortunately, this isn't the case. Researchers found that only 3% of day traders even make any money at all during a year, with less than 1% making more than minimum wage. Let's talk about it. Hello, my name is Max Monahan. I'm a real estate agent in Portland, and let's get right into why day trading is horrible. Before that though, please be sure to like the video if you're enjoying it so far. It does really mean a lot. And definitely be sure to subscribe as well if you enjoy personal finance and real estate related content. Anyway, let's get into it. Now first of all, what even is day trading? Investopedia defines it as the buying and selling of a security within a single trading day. This can occur in any marketplace, but is most commonly found on the foreign exchange market and the stock market. By definition, day traders need to monitor the markets for the securities they trade on a continual basis. They also need to understand the market forces that impact pricing. And of course, they need to execute trades based on an objective system versus letting their emotions govern their actions. Let me give you a few reasons why day trading is not the way to go when investing. Number one is that it's a huge time commitment. Day trading is not an endeavor that you can do on a here and there basis. Whether you're trading stocks, currencies, commodities, or futures contracts, the trading should be done when the market for these items is open. Day traders have to develop a system and spend most of their time examining the market with a fine-tooth comb for signals that it's time to buy or sell. So, in order to be a successful day trader, it's practically going to have to become your job. Day trading takes a lot of time, a lot of skill, and expertise. Becoming a good day trader is not a hobby by any stretch of the imagination. Number two is greater capital requirements. Day trading can result in rapid gains and losses, all in a single day. Typically, day traders will want to have sufficient capital reserves. In the case of day trading stocks, the SEC has set a $25,000 minimum margin requirement for a pattern day trader. The SEC defines this as any customer who executes 4 or more trades within 5 business days, provided that the number of day trades represents more than 6% of the customer's total trades in the margin account for that same 5 business day period. There are no minimum capital requirements for currency traders, and those contemplating day trading should definitely be sure to check for any requirements regarding the markets or the investment vehicles that they'll be trading in. Number 3 is higher tax rates. Gains and losses on day trading activity are subject to taxes just as with gains and losses on other investment income. Given the potentially high volume of trades, it is critical that you keep track of these gains and losses so as to not misreport your income to the IRS. Gains from day trading are considered short-term and are taxed at a higher rate than long-term capital gains. Currently, the gains made on investing assets that are held for more than 1 year are taxed at 15%. But if you're seeing gains on assets held for a shorter time period, you're going to have to pay a tax rate starting at a whopping 28%. The next downside I want to talk about is fees. Another way to grow wealth is to minimize investing costs. That means trading less, not more, because trading incurs costs even when there are no commissions involved. Investments held more than a year benefit from favorable capital gains tax rates. For example, those held less than a year are taxed as income if the trade wasn't made in a tax-deferred account, such as an IRA. Another way cost is incurred is in what's known as the bid-ask spread. The banks and financial institutions that facilitate trading in various stocks are called market makers. They offer to sell stocks at a certain price, the ask price, and will purchase a slightly lower price, the bid price. People who trade stocks instantly lose a little money on each transaction because of this difference. That's not a big deal for infrequent traders, but these costs can add up if you churn stocks in and out of your portfolio. The next thing I want to talk about as a downside is emotion. The biggest potential cost though is that every trade exposes your portfolio to the many ways we humans have of screwing up our money. We're loss adverse and we want to avoid regret, so generally humans tend to hang on to losing stocks. We think that we can predict the future or that it will reflect the recent past, when especially these past few years should have taught us that we can't do that. We also think that we know much more than we do, a cognitive bias known as overconfidence. If you're determined to trade or day trade, don't gamble more than you can afford to lose, because you almost certainly will. Lastly, I just want to talk to you about the stats that show that long-term buying and holding is much better, and a general disclaimer for people who want to day trade. If you're still not convinced, let me tell you some quick statistics to show you that for the vast majority of people, day trading isn't at all worth it. 1. The average individual investor underperforms a market index by 1.5% a year, but on average, active day traders underperform by 6.5%. Only about 1% of all day traders are able to predictably profit net of fees yearly. 3. The average day trader loses money by a considerable margin after adjusting for transaction costs. 4. 80% of all day traders quit within the first 2 years. 5. Among all day traders, nearly 40% trade for only a month. Within 3 years, only 13 continue, and after 5 years, only 7% remain. And as a quick disclaimer before ending this video and going to my outro, day trading is like going into the casino and putting all of your money on green, whereas traditional investing through tax advantage accounts with general index funds is what I would consider smart investing, and 99% of the time will outperform day traders. Now, thank you all so much for watching. I hope you enjoyed learning a thing or two about why you should never day trade. Please don't forget to like the video if you liked it. It does take quite a bit of time to make each video, and be sure to subscribe for weekly real estate and personal finance related content. Until next time, bye.